The Fed, it's lowered the interest rates again by 0.25 points. So let's see what that means for you, especially for those who are on the sidelines looking for the opportunity to either refinance or to probably get their hands on a house before the end of the year. So I have two articles here providing the update. So what we're going to do is first analyze one that's going to give you the update of what to look out for. I would say almost by the hour. And then we're going to look at some of the historical data. Although I have to highlight that the historical data doesn't necessarily predict what's going to happen in the future, but it's always a good to know in the event that you need to make informed decisions. So let's first start with this article right here by USA Today, and I'm going to go ahead and share my screen with you. I'm just going to take a little bit of water. It's been a long day today. There you go. So the lowering of interest rates. So this year, I mean, we're looking at the rates very closely. So last month, there was a rate cut of 0.25%. And then this month in October, we're getting another rate cut of 0.25 for a total of 0.5. So for some, that might make a significant change on the mortgage numbers. But for those who are looking to refinance, you might want to reconsider. And we're just going to go into the details in a little bit. So here are the updates courtesy of USA Today. Who really benefits from the lower rates? So this was published at 1:16 p.m. So just to give a general overview, when the Fed lowers interest rates, it aims to stimulate the economy and the job market. So lower rates make loans and credit more affordable, benefiting borrowers and home buyers. So rising rates or keeping them higher for longer slows spending to keep inflation in check. Higher rates can help customers by stabilizing prices. Just to make a note, when the Fed decides to either increase or lower the interest rate, it has a direct impact on personal loans, your credit cards, your car loans. It does not directly impact your mortgage loans. Your mortgage loans are more directly correlated, not always, but in general, with the Treasury notes, not necessarily what the Fed determines. Although whatever movement or whatever direction the Fed decides to take, it does have an indirect impact. Let's say, for example, the cost of borrowing becomes either more expensive or cheaper for the banks, which in essence, it gets translated down to you at the time of purchasing for your mortgage. But just so you know, and then another thing to highlight is that when it comes to interest rate decisions, most of the movements, you're going to see it in anticipation of. So let's say, for example, if there is an expectation that rates are going to go down, let me just remove this for a little bit. So let's say, for example, if there's an expectation that interest rates are going to go down, the market, it's going to move towards that direction in anticipation of. That's why sometimes you see a lot of movement in the market, but then on the day that the Fed decision is made, you either see nothing or you see the interest rate moving in the opposite direction. So just always keep in mind. So if you see something or you hear the news that, hey, the Fed might be inclined to lower interest rates and you are in the market to buy a home, just pay attention to what's happening with the mortgage rates and contact the mortgage broker if you have one to see if it makes more sense for you to make that decision in anticipation of before, so you can lock in that rate as opposed to waiting till after the decision and possibly end up paying a little bit more than what you need to. So back to the article. Interest rates take time to ripple through the economy, often 6 months to a year. And so that's also something else that you need to keep in mind. For everyday Americans, lower rates can translate to less interest paid on credit cards, car loans, and mortgages, making it a little easier to manage debt. But like I said, there's not a direct correlation with the mortgage, although indirectly it does impact it. So aside from that, if you're business owners, interest rate cuts can also help small small business, key engines of jobs creation that have struggled to weather high borrowing costs. So that's one point to take into consideration. Now, the next key question is, will a rate cut feed an AI bubble? Which is very interesting. So lately, several Wall Street observers have warned the stock market might be in a bubble territory. That's an analogy to the overhyped markets of 2008 and 1999, which crashed when those bubbles burst. If you want to play it safe, because I mean, AI, it's here to stay, it's not going to go anywhere. If you want to play it safe, instead of investing directly in companies that are doing AI, if you're afraid of the bubble, if I were in your shoes, I will invest in companies that are actually investing in AI. So not the AI company in itself, but companies that are investing in AI. So for example, NVIDIA is one of them, and it's one of the stocks that they're highlighting in this article. Microsoft, it's another one, or Meta. They're not necessarily AI companies, but they have invested heavily in it. So that way you can diversify it and you get a piece of the cake if you want to be in the AI sector, but you're not necessarily in it like 100% in the event that, you know, we turned out to be an AI bubble, because at the end of the day, we will really never know for sure until it happens. So the most you can do is just to play it as safe as possible and make informed decisions. That's what I would do. There was another highlight that I wanted to bring up here, and it didn't necessarily have to do with AI, but there was something else. So let me see if I can find it. I thought I had it here, but maybe when I refresh the page, you know, things switch positions. So at 2:53, there was an update on what Powell said about the December rate cut. And it turns out that, contrary to what most specialists or most analysts were anticipating, the December rate cut is not guaranteed. So the Federal Reserve Chair Jerome Powell said the committee has not made a decision about whether or how it will adjust its benchmark rate in December. For those who don't know, I mean, or for those who already know, the government is still in shutdown. So part of that decision was kind of made blindly. I mean, they did have some reporting come out that they use it as a benchmark to make the decision to lower the rates. But in reality, is we don't know what might happen in December. We don't know if the government shutdown is gonna extend until that point. And depending on the situation, the Fed might not necessarily be able to make a decision if they don't have the available data. So that's something that one has to keep in mind, right? So aside from the committee not being able to make a decision, Powell also noted that voting members share strong different views about how to proceed in December. Another reduction in the policy rate at the December meeting is not a foregone conclusion, but it's not something that they're considering doing right now. So for those who are actually on the sidelines waiting, well, you know, if September they lower the rates and in October they lower it again, how about we wait until December so that way it can close with the lowest rate as possible? You might want to reconsider it, because according to what we're seeing here, it might not happen, but we don't know. So what could be fueling that? It's the question, right? So it has to do with the slowing job market. So Powell acknowledged that job gains have slowed significantly since earlier in the year, suggesting a decline in the growth of the labor force due to lower immigration, which could also be a reason. Labor demand has clearly softened as well. And in the September, although the September jobs report was delayed, he said available evidence suggests both layoffs and hiring also remain low. And then here's a quote: I think there are two different things affecting the job market. One of them is just a dramatic reduction in the supply of new workers, and that's two things. That's declining labor force participation, which is a cyclical thing. And then there's the decline in immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So in addition, labor market demand has declined, so the unemployment rate has gone down, meaning the demand for workers has gone down a little more than supply. So that's what's going on. So it's mostly a supply function. Now, data delays, right? And this has to do directly with the government shutdown. So how are data delays affecting the Fed? How did it affect it now for this month, for the meeting that they just had this month? And how could that possibly affect the upcoming meeting in December? So while the government shutdown has postponed much of the Bureau of Labor and Statistics collection and dissemination of data, Powell said if there's a significant change in the economy one way or the other, I think we'll pick that up. However, if the shutdown were to last until the Fed's next meeting in December, Powell said that he could imagine a scenario in which committees members might want to proceed with more caution without official government data to guide them. So Powell is not committing to either or. He's just saying that, hey, we don't want to make a decision blindly, so everything is just TBD, right? Well, we'll see what happens. Here's another article that I wanted to go over, and it talks more about historical data, although I have to once again give the disclaimer that whatever happened in the past does not necessarily it's going to dictate what's going to happen in the future. However, it's good to keep in mind in the event that you do run into a situation where, you know, some of it might be similar, and at least you're not, you know, making a decision blindly. You're making it based on existing information, right? So I'm just going to skip through all of this and go straight into what happened, not here, but not September 2024. Let's just talk about December 2024, because right now we're already at the end of October, so it only makes sense to go back exactly 12 months, right? So in November 2024, a second cut didn't move the needle much. So in early November 2024, the Fed delivered another rate cut as part of a gradual easing cycle. And the mortgage rates were hovering somewhere in the range of 6.8 to 6.9, okay? Now, what was the reason that happened? So lenders were still pricing in uncertainty about the future inflation and the possibility that the Fed might pause its cut if price presumes return, meaning there was a lot of uncertainty at the time, and that uncertainty, it's also reflected on the mortgage rates, right? So this reinforced a key pattern where mortgage rates tend to adjust in anticipation of the future Fed's action rather than reacting directly after them. Like I mentioned, most of the market movements when it comes to interest rates tend to happen in anticipation of rather than post-mortem, right? Like post after what the decision is made. Then in December, there was a last meeting before the end of the year. There was a small year-end cut, but stubbornly high mortgages. So even though there was a small rate cut at the time, the interest rates were ranging somewhere between 6.8, let's just put it that way. So from one month to the other, although there was a rate cut, like it didn't really move the needle. And just to give you a bit of a point of comparison, this is where the rates are sitting right now. And you can see today it closed slightly higher after the Fed's decision. So it's currently sitting at 6.27 for a 30-year fix and 5.82 for a 15-year fix. And this data is coming directly from the Mortgage News Daily, which is they update the interest rates in real time. It collects data from all of the customers that are partaking in it, like at the same time. So this is as up to date as you can get, right? And so just to give you a point of comparison, in spite of like the most recent rate cuts, it hasn't been much of a difference because we're talking about a 0.50 reduction. So if you happen to be on the sidelines waiting for the right time to refinance, I don't necessarily agree that this is a good time for you to go ahead and refinance your mortgage, because you're just basically resetting the clock, and you're just cutting your rate by 0.5%, which it might not translate to more than $100 or $200 a month, depending on the size of your mortgage. But if you, let's say, for example, you bought your house a long time ago and you managed to get a lot of equity gain in your property, and you want to take that equity out to buy another piece of real estate, in that sense, it is worth it, because you're doing it with the intent to extract the money that is already in there, and you're looking to buy more real estate to keep generating more income. But if you're just refinancing for the heck of it, for this minimal rate cut, like you're actually better off taking what you will pay in closing costs and then just putting it towards the mortgage, because a reduction of $100 or $2 a month is going to take you years to recoup what you're paying in closing costs. So instead, you're better off just, adding that as an additional principal. It might not reduce your mortgage payment, but it will certainly reduce a lot of interest in the long run, which I think it's what we're looking to do. We're looking to reduce the most we can and not give that money to the bank, but instead like have the option to either allocate that additional funds towards the principal reduction so you gain more and more equity over the years, or why not just use that extra funds and just put it in a savings account and have it there as an emergency fund, right? Now back to the article. I wanted just to highlight, so that was as of last year. So when we fast forward to what's happening this year, as I mentioned, last month in September, there was a reduction of another 25 basis points, which is 0.25%, and that left the mortgage in the range of 6.4% earlier this past month, right? So the improvement felt more tangible for those who were looking to buy, which is a different scenario. When you're looking to buy, you're trying to get in and get your hands on that house and if possible, pay the lowest amount of possible on your mortgage, so that way you can afford a good quality of living, right? So, but if you are in the market looking to refinance, you might just hold off a little, but that's just my personal opinion, right? So, but then when you fast forward to October, now that the rates have been cut again in October, what can you expect? So according to the experts, with the Fed cutting rates for the second time this year, a lot of mortgage shoppers are hoping relief is finally on the way. The reality, though, is that the impact might take time. So in other words, the reduction of the rates might not directly be reflected in here. So if you were waiting on the sidelines to see what happened, you might need to wait a little bit more. If you reacted in anticipation of the reductions, then you got yourself a decent deal and you save yourself a couple of hundreds of dollars in your mortgage payments. But as of now, let's see what time will tell, right? And continuing with the article, if investors view this latest move as the start of a longer easing cycle, long-term treasury yields could fall, paving the way for slightly lower mortgage rates. Again, when the Fed lowered rates, there's an indirect impact on your mortgage rates. But if you want to see a more direct correlation, you should pay attention to the treasury yields, right? Because they have more of like a tangent move. So let's see. But if markets worry that the Fed is easing too quickly and inflation flares up again, those yields could climb, instead pushing mortgage rates higher. Still, the timing looks more favorable now compared to last year. Inflation has cooled compared to recent heights, though it did tick back up again. According to the latest report, it is now sitting at 3% for those who didn't know. And with the Fed signaling more rate cuts ahead, mortgage rates could gradually drift towards the low 6% range. But I don't know what they mean, because it is already sitting at 6.27, which I guess is considered the lower end, but they're probably referencing an even lower rate, maybe 6.05 or 6.08 or something, which is definitely more favorable than paying a 6.27. So I'm going to pause it right here. I see a couple of people connected. Any questions? I'll just open up the floor for questions. Here's one, what you think of your questions, if you have any, that somebody asked, right? So let's say, I read a comment recently about someone asking, hey, well, if I bought my mortgage, like my home, and I have a mortgage with an interest rate sitting at 7.5%, and here in the rate cuts, the two consecutive one that we've had this year, like in the later part of the year, does it mean it's more convenient for me to go ahead and refinance in hopes to lower my mortgage costs? Once again, it all depends, right? Because I think the size of the loan really matters. So if you're talking about a reduction of, if you're, you have to keep in mind, let me take a step back. Let's say, for example, if you were to go to Mortgage News Daily and you were to look at this rate, 6.27 or 5.82, depending on which type of mortgage you got, whether it's a 30-year or a 15-year, you might not necessarily get exactly the rate that you're seeing on the screen, because your individual risk factor also plays a role in the equation, meaning that if you're considered higher risk, your rate might not necessarily be sitting at 6.27. You might end up getting a higher rate, 6.50 or 6.75, probably even 7% or 7.25, right? So, so you have to keep in mind that these are just benchmarks. Making a note of that, now that you know that, the key question is to ask, if you were to go back to your mortgage broker or your lender and you ask, hey, if I were to refinance with the recent changes of the rate, how much with my new rate will be? And with that, how does that translate to my mortgage payments? How much am I actually saving? So if you're saving $100, $200 a month, I personally don't think it's worth it, because getting a refinance, it's applying for a brand new mortgage all over again. Everything is going to get reset. That means whatever you have paid down, it's going to get dismissed, because you're restructuring the mortgage to get a brand new mortgage for another 30 years. So if your final goal is to really get a reduction or like pay off your mortgage faster, you're actually better off taking what you would have paid in closing costs and make an additional payment towards the principal so you can pay off the mortgage faster. Yes, it will not make a reduction on your monthly payments, but it will help you significantly pay it off much faster than just making the actual minimum payment required. Again, that's only if you're looking to refinance just to lower the monthly cost. Now, if you have a much larger loan, let's say one that it's sitting at 1.5 million or $2 million, now that small percentage and interest reduction could make a large impact, a much larger impact in your monthly payment, and you can save something that is more substantial. In that case, it might be worthy to consider, but you will still have to pay attention to the closing costs, because if you're making a major expense to get this mortgage refinance, and it will take you years to recoup the amount of money that you pay towards the closing costs, once again, you're better off just taking the amount of money that you were going to use towards the closing costs, and you're just paying extra towards the mortgage. In this scenario, in my opinion, the only time that will be worthy to refinance, regardless of your interest rates, will be whether you have equity in there sitting in that property, and whether you plan to use that equity for something else. Are you going to buy another property so you can generate more cash flow, or just increase your rental portfolio? Do you plan to use that money and invest it in a business? Are you going to buy a business? Are you going to use the difference and invest it in the stock market? So now we're talking that you're getting into more debt, because refinancing, that means you're pulling the equity, and that mortgage, it's going to be bigger, because now you're using the actual appraised, the appreciated value of that. So that means your monthly payments are also going to increase. But yet, if you're extracting the cash out of that equity, that means you can put it to a use for something useful. Just don't use it and spend it on, I don't know, parties and like, I don't know, like Lamborghinis and stuff. Like just use it for an increase in your net worth. Like, use it for something that's going to help you be in a better financial position. Then at that point, it will be worth it to go through the entire refinance process. Nelson Salada, I have thank you for tuning in. So Nelson is asking if FHA is a lower rate. Once again, Nelson, it will all depend on your own risk profile. Overall, FHA loans, they do require, they give you the flexibility to purchase a home with a lower mortgage, but not a lower mortgage, a lower down payment, I meant to say. But personally, I'm not a big fan of FHA loans, because they require a PMI that you will never be able to remove from the mortgage, meaning you're going to have to live with that PMI for the rest of the remaining 30 years or so that you're going to get stuck with it. If you were to consider a lower down payment option, you're better off going with a conventional mortgage with a low down payment. That way, once you start amassing equity in your property and you hit that 20% equity, you can actually call the lender and ask them to remove the PMI, so that that is one less extra expense that you have to pay. For those who are brand new to this, a PMI means a private mortgage insurance. Any purchase that's done with less than 20% will require private mortgage insurance. The key question is, are you going to use it on a conventional mortgage that gives you the option to remove the PMI, or do you want to go the FHA route and get stuck with it forever? Now, in terms of the lower rate, that will depend highly on what the market dictates, meaning how things are moving. That's why I share this website right here. You can actually download the app as well, Nelson, Mortgage News Daily, and that information, the rates that you see there on the screen, gets updated in real time. So when you are going to shop for mortgages, you can use that as a benchmark, but mind you that depending on your risk profile and your credit report and your income and the amount of that down payment you decide to make towards the purchase, that rate that you're seeing on the screen, it's going to fluctuate. It could fluctuate on the higher end, or you might get lucky enough to get exactly what you're seeing on the screen. But for the most part, for most buyers, it's going to trend upwards regardless, because there's always a risk factor that comes into the equation. One thing you can do if you really want to explore a lower rate option is to ask your lender for the possibility to buy down rates. So there's going to be a fee associated with the rate, and every time you buy, it's the equivalent of a point. So then you can ask them, hey, is there an option for me to buy down the rate? So that's an option aside from having to depend on what the market dictates. You're going to have to come up with the money to buy down the points, and as you buy down, you can guarantee a lower rate. But try to consider if you can go on the conventional side of things. There is a program, to elaborate more on your question, Nelson, that is issued by Rocket Mortgage. Rocket Mortgage has a program where you as a buyer, you can pay 1% as a down payment, and you will qualify for a 2% grant that is provided by Rocket Mortgage. And so with the grant and with the 1% that you put down, you're buying the property with a 3% down payment. You can put down up to 3% out of your pocket. So if you put down 3%, you will still qualify for the 2% grant, and combining those numbers will get you to a 5% down payment. So it's definitely a great program to buy. The only downside of it is that there's a cap. I believe it's capped at $350,000 for the value of the home. So if you're living in an area where the cost of living is quite high, like LA or Boston or New York City, chances are it's going to be a little hard for you to get something in that range unless you go for a studio apartment. But if you're living outside the big cities, there's a high chance that you can get a decent sized single family home just paying a low down payment. And that could help you get your hands on a property and then figure out what to do with that next, and hopefully help you with affordability. So thank you, Nelson, for your question. That certainly gave a topic of discussion. I see more people connected. Are there any other additional questions? Feel free to ask them away now. Otherwise, I hopefully get to see you in the next video, in the next live. And if for whatever reason you're watching the replay, feel free to leave your questions down in the comment section below. I do check my comments quite frequently, and I'll do my best to respond to your questions if for whatever reason I didn't manage to answer those today. So going once, going twice, I guess no one else has any answer. Just checking on Instagram. Thank you for tuning in, Rena, Lise, and Ravi. Thank you for connecting. And let me see, I hear another comment. So Nelson, you are in LA. looking for 600 and 700. Okay, so in that case, Rocket Mortgage might not work out for you because of the limit, but you can still go the conventional route. It's definitely a lot more flexible when you go that down that path, because let's say if you do any renovations on the property and you force the appreciation of it, then you can request for the PMI to be removed much sooner, as opposed to getting stuck with the PMI for the rest of your life, or at least for the next 30 years or so. So thank you so much for your question. Thank you for tuning in, and I guess I'll see everybody the next time. And any questions that I didn't get to ask, feel free to just leave them in the comment section below. I'll see you all in the next video. Take care. Thank you, Nelson, for tuning in too. Bye.